So thanks once again for coming along to our CHASM seminars. It's so nice to see so many of you here. What's starting to happen is that we're getting a lot of people sort of as regulars at our CHASM seminars, which is really, really nice to see. And as I say, we've got 3 people today, and we're absolutely delighted to welcome them all here at what is a very, very early time in the morning for them. We've got Jerry Buckland, Wayne Simpson, and Jennifer Frimpong, and I think it's just about 7 a.m. Where you are, guys. Is that right, in Canada? So extra special thanks for coming along to talk to us today at such an early hour in the morning. Jerry Buckland is an economist and professor of international development, University of Winnipeg. He specialises in financial ecosystem studies and regional and community development. He's authored many articles, many in the fields that are highly relevant to CHASM, including 2 recent books on personal finance, Building Financial Resilience in 2018 and Payday Lending in Canada. With a large research team, Jerry is researching and working currently on a 5-6 year long study, the Canadian Financial Diaries, which is the subject of today's seminar, and that's exploring the dynamics of low-income people's finances. Jennifer Frimpong is a PhD candidate at the University of Manitoba in the economics department, and her research interests are in development and labour economics, with a particular focus on financial and labour market outcomes for women. Jennifer's currently using the data from the Financial Diaries project and also using Canadian confidential data sets to investigate the impact of immigration policies on women's labour market outcomes. Jennifer's in her 4th year, aren't you, Jennifer, and hoping to finish reasonably soon. And Wayne, last but not least, Wayne Simpson is professor in the Department of Economics at the University of Manitoba also, and a research fellow in the School of Public Policy at the University of Calgary. Wayne has an English connection in that his PhD was from London School of Economics, and he specialises in economics, urban and regional economics, applied microeconomics, and social policy. He's author of Urban Structure and the Labour Market, Analysis of Worker Mobility, and also co-author of Income Maintenance, Work Effort, and the Canadian Mincome Experiment, the Minimum Income Experiment. So his recent research interests also include balanced budget legislation, social assistance, and redistributive tax policies. So a bit of a whistle-stop tour of some of the key kind of areas of expertise and research interests of our speakers. And as I say, I'm delighted to welcome you all here today. So thank you very much. Without any further ado, and if everything is okay with you guys, I'm gonna hand over Jerry, if that's okay.
Okay, thank you so much, Louise. Wonderful to see you all. And also Helen, thank you for all your help. And Davina, we just met this morning. I'm going to share my screen. I hope everything will work. Could I just confirm that you could see my slides? Oh, yeah, great. Thank you so much.
That's good.
We are talking about some of the results from our phase 1 of the Canadian Financial Diaries research project. Phase 1 involved 28 people that we worked with for 1 year in a financial diaries methodology that involved both quantitative and qualitative data collection. Finished in 2019, and we've been working away on those data. We've got several different reports that we're working on. This particular one is an article that we're focusing on, that's focusing on the sort of the financial literacy angle of people with low income, and you know, what was the evidence of financial literacy, and we're taking that off of what we saw with their financial behavior. So that's the focus today. In Canada, very commonly today we do a treaty acknowledgement, and so this might seem a little bit unusual, but in Canada, because of the Truth and Reconciliation Commission that is seeking to promote reconciliation between Indigenous and settler people, this is a very common thing. So I'm speaking to you from Winnipeg, which is the location of Treaty 1, one of the treaties that was made between settlers and Indigenous people. And the Indigenous people in this area include the Anishinaabe, Cree, and Dakota, and it's also the homeland of the Métis people. One of the things that we also think about in terms of truth and reconciliation is, well, what can we do now in terms of reconciliation? And one of the calls in the plan of action for truth and reconciliation, number 55, was to provide greater detailed information about Indigenous people in Canada and their respective situation in terms of income and employment, et cetera. So that's something that we take seriously at the Diaries Project, and we have had Indigenous participants, and we see that as an important way to understand their particular situation and challenges. The format of our presentation, I'm going to do a bit of an introduction. Wayne will talk about methods. Jennifer is going to introduce the participants. And then Jennifer and I will both talk about results, and Wayne's going to wrap it up with a discussion. In terms of introduction, the place that we're seeking to situate this conversation in is literature on financial literacy or financial capability. That is the knowledge, skills, and attitude that people have in order to achieve their financial and overall life goals. This is a literature I'm sure many of you are very familiar with. It's I think, a very important literature. It's partly flowing from the increasing financialization we're seeing today. One of the things that we're interested in the Diaries Project is to understand the connection between people's literacy, their knowledge, pardon me, and their actual action, their behavior. And we were able to see that by working with 28 people week after week. We followed their behavior, their actions, so we can make an assessment of what is their literacy in action. So by way of background, some popular theories that seek to explain financial behavior. Again, you're all probably very familiar with this. One theory is sort of the life cycle theory that's premised in rational choice or neoclassical economics, which says that individuals are operating in frictionless markets and they make rational decisions to maximize their utility. One of the common ways that this is measured is by using a universal indicator to assess a person's financial literacy. And I'm going to talk about this in just a minute, a little bit more. Other common theories today are the tunneling scarcity view that's flowing from a more bounded rationality, behavioral economics perspective. Here, individuals are not necessarily behaving in fully rational ways. And in some cases, they even drop the assumption of a frictionless market. The third sort of approach to understanding financial literacy I described as more of a structural institutional approach, which completely drops that assumption of a frictionless market and argues that rather there are structures, institutions that are not working for some people, and those create barriers for them to make good choices. So just to say that we in the Diaries Project have recognized these three different approaches to understanding financial behavior and literacy, and want to hear from our participants, like what are they saying? What are they experiencing? There are many studies in the field of financial literacy that do assume this sort of rational choice perspective. And what I've seen when we make those sorts of assumptions is studies often come to the conclusion that there is a positive relationship between financial literacy and income level or asset level, some indicator of their finances. And this particular conclusion, I think, is the one that I really want to challenge here. In other words, are people with low income less financially literate, or is there something else going on here? And that's what the Diaries, one of the things that the Diaries has presented us with. And I think the behavioral economists have pointed out that there, in certain situations, are scarcities that people face that don't enable them to make rational decisions. But I would also say that the structural institutional perspective is very important and maybe is underplayed in that behavioral approach. And we want to investigate this in the Diaries Project. Like, are structures, institutions, for instance, banks, working to enable, rational choice in a frictionless market? So just by way of background, we think of individuals in terms of their financial behavior having sort of a set of internal capacities and operating within external structures. So there's both the internal things that are driving their sort of choice, their demand, and that has to do with their assets. Do they have money to save or not? Their interests, are they thinking about the long term, or are they really forced to focus on the short term? What are their motivations? Are they motivated to get for instance, more employment? Wayne's going to talk about that. What are their needs and what are their aspirations? So there's a set of internal capacities that drive people's demand. On the external side, there are a series of institutions that affect their finances. For instance, banking. Are there banks nearby, or do they end up going to a payday lender? What about employment? Are they in a fully employed situation with, full benefits, et cetera? Or are they piecing together employment through a series of part-time jobs? Government institutions, are they supportive? And are there, supports for you if you're unemployed, or either in the short or long term? And then also retail and housing affects a person's well-being in terms of that external structure. And I pick up on this slide a little bit about the bank point and how banking experiences vary in Canada considerably by income level, particularly when low-income people live in neighborhoods where average incomes are low. Of course, low-income people live all over in urban settings, suburbs and inner city, but generally speaking, we see a higher concentration, of course, of low-income people in low-income neighborhoods. And in those neighborhoods, we see typically an absence or a low number of banks and a preponderance of payday lenders. And so what we're curious to understand in the Diaries project is, how does this institutional setting affect their decision-making, their rational choice? So we have a little bit of reference to that later on. Now, I'm just going to pass it over to Wayne to talk about the methodology.
Okay. Most of our quantitative work is really, at least from an economist standpoint, is really about secondhand data. That is to say, these national, sometimes industrial surveys, but mostly household surveys about the financial dynamics and the kinds of outcomes regarding employment and income sources and so on. But there's some limits to that, certainly in terms of what we can learn. There's certainly some limits in terms of understanding the causal effects, because really most of that data is cross-sectional, and it gives us snapshots of what's going on, sometimes fairly detailed snapshots in terms of a lot of the demographic as well as economic and social information. But largely it's limited to that kind of information. And the diaries attempt to extend that, both in terms of adding more qualitative information, but also in terms of looking at individuals through time in a longitudinal perspective that is often very useful in figuring out some of the causal relationships that we're interested in. Next slide. I came in 2019, I must admit. Jerry's been working on it a lot longer than I have. It goes all the way back to 2010. 2017, the SSHRC grant really got it going in terms of the current project. They've been testing since 2017 and recruitment in 2018. There is the interviewing of individuals, the 12 months of data, or up to 12 months of data that we have for each of the 28 final participants. I came in really at the data cleaning in 2019 when the prospects for quantitative analysis began to emerge. I've been involved in this analysis and reporting section, I guess you'd call it. They're now Jerry's now actively involved in a phase 2 project, which attempts to learn to some degree from what has been gleaned in phase 1 and more carefully explore some of the questions around financial literacy and the outcomes for low-income people. So next slide. So far we have this limited data from the Diaries project. The objective is to use what we call mixed methods, or what is called the literature mixed methods, which is to combine the fairly voluminous qualitative information we have with the quantitative information, which is the kind of information you often get from national surveys, insofar as low-income households are covered by those surveys, which sometimes is a bit questionable. We're also trying to work with regulators to try to promote financial empowerment. In particular, we've done some work with the Bank of Canada, and we see them as a potentially important partner. We did a seminar with them earlier in the year. And we're now into the, as I said, phase 2 of trying to see, what we can learn from this project and how it can assist low-income households in their financial affairs. And so this is kind of a full circle arrangement, I guess. You start with the quantitative methods, the household financial flows for 1 year, the diaries project, the quantitative side, which we have a little bit of information on, I'll talk about later. We've got voluminous qualitative information as well, these weekly discussions and quarterly interviews, trying to get from that, combining both the qualitative and the quantitative information, a better understanding of the financial arrangements of Canadians with modest income, and trying to use that to, as Jerry said, look at the theories that are out there and develop them in a way that'll provide a better foundation for empirical testing with a representative sample, essentially a larger data set with a more well-developed frame for gathering information. And I'll turn now to Jennifer.
Okay, thank you, Professor Jerry. Okay, good. So this is the information about the participants in phase 1. So in phase 1, as Jerry said, we had 28 participants, and most of them were women. We had 23 women. And we understand this is not a representative of the whole Canadian system. However, it gives us a bit of information about low-income people in the country. And in terms of age, the ages ranged from 19 to 63 with an average age of 42. And in terms of education, even though they are low income, they have a bit of education. We have education, average education of 14.2. And the household size were also relatively very small. We had an average household size of 1.7. And most of our participants were renters. It's just about 1 or 2 of them who live with their family, their parents, and the others were homeowners. And all of them have a bank account. And in terms of credit card, just 21, and that actually comes in the fact that they are low income. So most of them were unable to secure credit card. And the diary participants were, it's come from, they are people from diverse groups. We have people who are indigenous, we have LGBT community people in there, we have newcomers and people on EI and disability. And in terms of their income, we realize that most of the people have income below the official poverty line. So we use the official poverty line in Canada, and just about 9 of them were above the official poverty line. And in terms of the net worth, we realized that these were people whose net worth was very low. Okay, it was about $3,117. And if you compare it to the 2019 net worth of Canadian families, we realized that it was just about 1%, which makes these very interesting. Next slide. Okay. Yeah.
Well, thank you, Jennifer. And then the next few slides, actually, Jennifer, Wayne, and I will mix up a little bit who speaks. So we had a lot of data. We had a lot of both qualitative data because of the interviews that we did, and a lot of quantitative data. I think over 13,000 transactions. And I would say that we're still analyzing those data and still learning. But one of the ways I think in which we learned kind of key things from the data was actually through the data collection phase, because really it was more than a data collection phase, it was a relationship building phase. Oh, pardon me. And in that phase, we really got to know our financial diary participants very well. One of the things that came out clearly from the interviewing team through that data collection phase was that there seemed to be sort of three groups of people. Now, remember, these are both low and modest middle income people, largely based in Winnipeg. We had a couple outside of Winnipeg. But it seemed as if three groups really bubbled to the top. So there was one group that we would describe as being clearly in a kind of financial crisis. And this financial crisis actually bubbled into other parts of their life. So there seemed to be, emotional crises and social crises going on with these people. What were some of the features of these folks? So there were 5 people who were in this category. Well, they had very low income. One of the things that we noticed for our project was they had difficulty tracking their finances. And of course, that was a key thing to be a part of the project, to track your finances. And for that reason, actually, at least one of these people dropped out early because it was just too difficult for her to track her finances. It caused her too much emotional struggle. Also, within this crisis group, we saw people having difficulty keeping spending within income limits. Like they just struggled to keep their spending limited. We saw also that they were going to unsustainable debt. They had, we're not talking large debt here. We're talking still very modest debt, but because their incomes are so low, it's unsustainable for them. And in some cases, they were going to unsafe credit products like a payday loan. There were also these interesting personal and social consequences of the crisis. So in many cases, sort of complicated family relationships where, interestingly, a person in financial crisis seemed to be lending and gifting money to family members, even though they couldn't afford it. So this is kind of hard to understand. We notice this especially among women in financial crisis, and recognize there's a gender dynamic that we are looking at in another paper, actually. And then finally, emotional turmoil was something that we saw with this financial crisis group. The next two groups, the financial vulnerable and financial resilient group, they actually have quite a bit in common. And so I don't need to go through all these points. The big difference between these two groups is that the vulnerable group, their incomes are low. The resilient group, their incomes are more modest, but in many other ways, many similar features. So both groups tended to be very good with tracking their finances. Both groups were careful with spending, keeping their spending within income limits. And so there were, some common similarities there, but the vulnerable group just was sort of right at that border. You could imagine they talked about, if they were hit by some kind of shock, that they would be in crisis. Whereas the resilient group, it was clear that if a shock hit them, unemployment, health emergency, et cetera, they would be able to get through it okay. And just parenthetically, we saw this actually happen through the pandemic. Now, our data collection was done when the pandemic hit, but we went back in the summer of 2020 and spoke with all of the participants that we could in a follow-up survey. And interestingly, what we found was that the vulnerable group, they tended to be less, they could not access the emergency benefits that were available for many Canadians because they didn't have sufficient employment income from last year. Whereas the resilient group, because this group is typically fully employed, they met those criteria of having the sufficient employment income from the previous year, and they got the emergency benefit. So it was a very problematic outcome of the pandemic emergency benefits, that people who didn't have that employment income from the previous year didn't get the support. Okay, Jennifer.
Okay, thank you, Jerry. Okay, good. So these in these slides, we realized that these are people who are low income, but they are careful spenders. They are very careful in terms of what they spend their income on. So we realized that about 60.7% of them had income above the expenditure, which was very interesting because as researchers, if you look at their weekly spending, you go like, okay, they are going to spend more than their income. But then that wasn't the case. We had just about above 20% whose income was below their expenditure, and about 17.9% of them with income equal to expenditure. And that is really, really interesting about these participants. Next slide. Okay, good. So we were also trying to look at in terms of their basic needs and non-basic needs in terms of expenditure. And indeed, we could see that these are people who also spend income on things that are more important before they go to things that are not important. And if you look at it, we realize that about 20 out of the 28 participants were spending most of their income on basic needs compared to the non-basic needs. Okay, and we try to look at the relationship between the basic expenditure and income, and you realize that that was a negative, and that actually explains that as your income decreases, you tend to spend more of your income on basic expenditure. Next slide. Okay, good. So again, in terms of careful spending, these participants are also even though they don't have income, all of us agree, but then those who even own the credit card, they tend to pay back their balance. So we realized about 8 of them, okay, so 4 out of the 8, once they spend, they use a credit card. They are kind of, if you read the information in the diary project, you realize that they are very scared of being in debt. Most of them, they are scared. All right. So if you realize, and 4 of them, they pay their balance once it is due. And just about 7 of them were struggling to pay. And 6 of them do not want to use it at all. And if you read the diary information, they will say, oh, I'm just scared. I'm just scared. They just want to own the credit card without use it. And we also realized that some of the diary participants were careful tracking. So they kind of, because these were a project where you have to track your kind of everyday spending, right? So you realize that most of them were good in terms of the tracking. And in terms of measuring the quality of the information that we get from them weekly, about the average was about 87%, which we feel was good. And most of them were within the phase of 50 to 98%. Yeah.
Yeah. So Jennifer has, presented some data that shows the careful financial management of most diary participants. That's not to say that everyone was, completely careful, or that there weren't some who were struggling, like that crisis group I spoke earlier. But overall, the data we saw supported the idea that these participants are careful with their finances. They have to be. Their incomes are meager. They don't have access to much credit. Another thing that we did was we interviewed participants about what financial well-being meant to them. So we didn't go to them with any definitions. We just said, hey, what would it look like for you if you were in a financially well situation? And what we heard from them were sort of 3 key points. Number one, that they had a sense of control over their finances. And I remember one participant saying that she could control her finances and that her finances wouldn't control her. Like, that was a clear message that they didn't want to feel overwhelmed by their finances. They wanted to be able to meet their needs and to distinguish their needs from their wants. And, they can leave their wants for later, but they needed to focus on their needs. So this is clearly a very important thing for many participants. Another point was this idea of sufficiency, that participants recognized that, they would meet their needs first, and that was their goal, but they would like to have a little bit more, a little bit extra, so that could, cover additional things. So they weren't looking to become wealthy. They were simply looking to have their needs met plus a little bit more for emergency, for savings, for trips, for friends, etc. And then finally, the importance of social support. And this is something we haven't really highlighted in this presentation, but it's something, another thing that we're looking at from the diaries. The family and friend support is so critical to our participants in a variety of ways, and maintaining those social relationships was clearly important to them. And I'm going to hand it off to Jennifer. Okay,
thank you, Jerry. Okay, good. So we were also trying to look at, in terms of income, try to compare it among a group of people. So we had 4 groups. So the largely unemployed, they basically get their income from the government. So we have the employment insurance or disability benefit. Then we have the casually employed. Definitely they take fewer hours than the fully employed. Then you have the retired. And when we did the investigation or the quantitative analysis, we realized that the fully employed, as expected, they had higher average income, which was followed by the retired, casually employed, and largely unemployed. And that was the largely unemployed were about 11 people. And you realize that even though they have low income, they have the lowest average income, they tend to kind of smoothing income from month to month. And as you could see, the retired is second. The question will be, how can somebody on retirement have higher wages? But then the main reason is that they derive income from both the government and private, because they will definitely have private pensions and government pensions. Yeah. Thank you.
Okay, this slide's mine. The exit from reliance on government assistance is still mostly predicated on earnings. And the American Diaries had pointed out the issues around earnings volatility and its role in not only precarious employment, but also in terms of the kinds of concern that people had with their own financial situations. And so in looking at that, this diagram shows, or this graph shows the different groups that we have in our data. And there really are 3 groups. One is the group that is entirely dependent on government assistance, the group in red with the red box around it. The group that is pretty much entirely reliant on earnings, which is the yellow group. And then an interesting group, the green group, which is a mix. Some of their income comes from government assistance and other sources unrelated to the labor market, and a significant part of it comes from employment income. And we can see there in this graph, which on the vertical axis has income volatility, and on the horizontal axis has a percentage of their income that comes from employment, that as the percentage of their income that comes from employment, which is their vehicle for moving beyond government assistance, government income assistance, their total, their income volatility tends to rise. And this can be a source of their concerns about their financial situation and their ability to plan their financial affairs.
And just for the purposes of time, I think I'll go very quickly through the next 2 slides, and then Wayne's going to wrap us up. One of the things I made reference to earlier is the importance of, social connections, family, friends, etc. Another thing that we saw related to that is the importance of the informal finance or informal economy. And so we saw, the importance of lending and gifting circles, food banks. Many of our participants were very active in supporting various charities. And so this was, an interesting thing to see. I made reference earlier to this issue of bank exclusion, and I won't spend time on this slide, but just to say we certainly saw evidence of bank exclusion and how that institutional barrier, reduced people's opportunities. And, if we have time later on, I'd like to share about Katrina, who had a very difficult experience with a bank, and it very clearly affected her financial well-being. But I think I'm going to pass it over to Wayne.
Okay, well, yeah, we promised we wouldn't go on too much beyond half an hour. We're already beyond that. So there are kind of two groups. There's a significant group, about 3/4 of the sample, that demonstrate strong levels of financial literacy. They have limited options, but they're careful financial managers. They're mostly below the poverty line, but they're frugal, and in some cases, they're relying beyond government assistance to family and friends for help. There is a financial crisis group, a smaller group, that act in ways that are inconsistent with their longer-term interests. Many of the participants are opting for lower and more stable social support as compared with employment, which led us to questions about, the nature of income support. So one more slide, two more slides, I guess. So currently, income support in Canada, I think much like the UK and other jurisdictions, is one, inadequate. Secondly, doesn't reward work very strongly, and involves a fairly significant set of bureaucratic interventions that introduce not only that impose work requirements and other requirements for receipt, but also introduce some uncertainty over the eligibility for benefits. And attempts at welfare reform typically tend to move towards what we call a basic income guarantee or negative income tax model, to augment benefits, reward work more strongly, and streamline benefits delivery, essentially through the federal tax system, and in that fashion to eliminate work and other requirements. The next slide. And the question we ask is whether these low-income individuals might benefit from welfare reform. We think there's some indications that they would. Certainly their incomes being closer to our official poverty measure, the market basket measure, would enable them to purchase the basic necessities, including, although usually we think of necessities as food, shelter, and clothing, things like communications technology are such that that's an important consideration as well. Give them more income stability and streamline their benefits delivery, making the use of government assistance less onerous. What would change? Well, from a federal standpoint, it would require people to be regularly filing taxes to receive their benefits, which is, in the Canadian case for all but Quebec, the federal government manages the collection of taxes and the payment of benefits from that. Currently, the benefits are paid at the provincial level, but this would move it to the federal tax authority. The provinces would still have to deal with emergency assistance in a fashion that income assistance was generated back in the 20th century, early part of the 20th century. And they would still be responsible for basic services, but this would cleave off the income assistance section of it that is the thing that we're most interested in here. That's it. Thank you. Ideas, comments, questions, etc.
Thank you.
Wonderful. Thank you. Thanks, Jerry. Thanks, Jennifer. Thanks, Wayne. And very slick presentation. Very, very well done to do that between the three of you. Such vitally important work, and there's so much there. I can absolutely see why you are still analysing the data, and I'm sure will be for quite a bit of time to come.